Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. For those of you that missed it, I had a good interview with Jared Dillion of the Daily Dirt app. So that should be posted here on YouTube in the next few days. Next week on Wednesday, 7 p.m. Pacific time, I will be doing another webinar live Q&A with Professor Steve Keen, the author of Can We Avoid Another Financial Crisis? This book is probably an extremely important read given where we are today, so I'm very much looking forward to Steve Keen. Basically, he talks a lot about the fallacies and misunderstandings of how money is created, understanding basically the banking system and the economy, and how that all sort of ties in together. So very much looking into that. Again, there'll be a link below to register for that webinar in the description, so if you want to check that out. This week, want to dive into the jobs numbers obviously coming out for Canada. So I'm going to pick through those, my thoughts on sort of the mortgage delinquencies. But I think first and foremost, to sort of to frame this whole picture up, is, as you can see, we are starting to ease up on the restrictions. Some of the virus fears are starting to abate. And so we're going to start, reopening the economy. And, here in BC, John Horgan was coming out and saying, well, we're going to implement phase 1. You can, mingle with a few people, and then phase 2, and then phase 3. If you actually read it, he says phase 3, sporting events, concerts, literally says could be a couple years away. So basically, I don't know if anyone actually read that, but this guy is basically saying that they suspect that you're not going to see basically sporting events. So if you don't want to go to a Canucks game or a Toronto Maple Leafs game or what have you, there might not be fans in these stadiums for the next 1 to 2 years, based on what they're saying. Basically, it seems like until they can kind of wrap their heads around this thing. So keep that in context as we discuss reopening the economy and getting back to normal. Because I have my concern is that when you talk to the typical person, the average person, I get it, maybe they're optimistic by nature, maybe they're just less informed. There's this belief, there's this notion that everything's just going to return to normal, the virus is starting to kind of go away, and everyone's just going to get their jobs back, and it was nice to kind of get 2 months off, collect your $2,000 check, have a couple beers, hang out, kiss the wife and kids, and you're just going to move on to the next thing. And I truly believe, I certainly hope it goes back to some sense of normalcy, but I think that people are underestimating that the economy cannot simply be turned on and off, and the fact that you have entire business models that are going to have to be redesigned. We've talked about this before, but you have restaurants that, again, they're going to reopen, but at what capacity? 25%, 30%? Businesses cannot make money in that environment. Think about airlines, for example. Okay, so airlines are going to, slowly resume. They're going to get kind of back off the ground. But what about the middle seat? Who's sitting in the middle seat? And how? So if airlines can't sell the middle seat, how are they going to make money? Okay, so Ryanair, which I believe is one of the largest air carriers, or volume anyways, in Europe. The CEO came out publicly and said that if they can't sell the middle seat, they cannot survive. So these business models just don't work in this new era, this new environment. I was actually hearing from a friend that works at Nordstrom's. And they're saying anyone that comes into Nordstrom's now, moving forward, when they reopen, anyone that comes in, tries on a piece of clothing, and if they don't purchase it, that clothing then has to be picked up, and the clothing has to be essentially quarantined for apparently 10 days. It has to be kind of thrown in some freezer or whatever, or some sort of dry storage area where it can't be put back on the shelves. So again, these massive companies have created perfect systems. They've systematized their businesses, which has allowed them to scale, and now you're coming in and basically taking a sledgehammer to the systems that they have created. So it's just not that simple to simply restart. And which brings me back home to, we have, the April employment figures in Canada. We lost 2 million jobs. As you can see here, 2 million jobs lost in April. This is actually grossly understating the reality. So you had 1 million lost in March, 2 million lost in April. But if you compare it with the CERB program, there's over 7 million applications, which basically indicates to me that obviously there's some fraud, number one. But number two is that you have a lot of people that maybe aren't completely unemployed or laid off, but are maybe in the process of being laid off, or they've seen a dramatic reduction in their incomes, where they're now collecting the CERB. So I think that the unemployment figures, the unemployment rate, which now stands at just under 14%, the worst since 1982, is understating the severity or the weakness in the Canadian employment sector. And the naivete of these individuals who've been laid off. So, for example, Statistics Canada says that of the people that they polled that have been unemployed or laid off, 97% of them believe that they are going to get their existing or their previous job back. So that just goes to show you the positivity that I think is being priced into the market. So obviously, again, I hope for everybody's sake that they do get their jobs back. Again, I have family, dad, fiance that have been laid off as well. So I certainly take no pleasure in seeing this heartbreaking destruction of the economy and of people's lives. But we have to be realistic and say, well, okay, in a scenario where businesses have to basically reinvent their business model, how realistic is it to simply go back and rehire everybody? And number two is we're entering the summer, which is great. Everybody can kind of go enjoy the winter or the summer season. But what happens when the fall and the winter comes? And seems to me, I'm certainly not the virus expert, but I am reading a lot on this topic. I am watching a lot of interviews with the experts, and obviously trying to filter out as much of the nonsense that I can. And it seems to me that there's a very strong consensus that a second wave is inevitable, and it potentially could be even more damaging than the first wave. At least that, again, from a historical context, was the situation in the 1918 Spanish flu pandemic, where the second wave was significantly worse and killed a lot more people as the virus kind of mutates. So again, I certainly hope that's not the case, but I think that we have to be realistic and say, okay, there is a decent, or I would say probably a strong probability that is going to happen. Now, as a business owner and operator, if you are looking at, say, CapEx, if you're looking at your business and saying, okay, I don't really know what the future holds. I'm not sure if we're potentially going to get a second wave. I'm not sure what the revenues are going to look like. I'm not sure, if the people buying my product are going to be enthused about spending money. As a business operator, it is very hard to make investments and maneuver in that kind of environment. How do you just go out there and deploy hundreds of millions of dollars on rehiring employees and expanding your, say, office space, or making investments in various CapEx projects? It's just not realistic. And so obviously we're seeing a lot of companies basically scale back their CapEx, and it's going to take significant time for them to be comfortable to then slowly start to expand. They're going to have to make sure that their customer base is able to be sustained to begin with. So again, this is kind of my personal view. I certainly hope that it seems like financial markets are doing better, but I think it really brings me back to the point, looking at again where I see the outlook moving forward is if you actually look at the Canadian jobs statistics and do a little bit of a deeper dive, you can actually see, and this is what I've talked about before in a lot of my interviews, is that the sector of the working force that is hit the hardest is the lower class and the middle class. So you can see here the percentage of job losses by sort of income bracket. And so the high-end income earners have been the least impacted versus your middle class and lower class levels. So, if you're asking me, well, as I've said before, my belief is that if you want to look strictly at the housing market, the rise in mortgage delinquencies or foreclosures is going to be most prevalent in the suburbs. That is in my view. That was what happened in the 2008 financial crisis, particularly in the United States, is that these lower income, middle class suburbs, that probably enjoyed large price run-ups on the back of credit growth and speculation, are the most susceptible to an economic shock, because there's not a whole lot of savings there. There's a lot of, it's a less educated cohort. It's these jobs are just more susceptible by nature. And so that obviously concerns me, because then moving forward, I think that based on central bank policy, based on government policy, is we are creating a larger wealth gap where as we can see, the higher up income earners, particularly, and those individuals, generally speaking, have assets, and they have more cash reserves to then invest when those assets, come on sale. Whereas the lower middle class doesn't really have that rainy day fund, and so you're going to see a larger wealth gap as we come out of this over the next several years. And this is obviously something that Ray Dalio has talked about a lot, is that these shocks end up just creating this larger friction, and that can see where policymakers are going through this massive quantitative easing programs and low interest rate policy, that it's all geared towards boosting financial asset prices. And that's certainly what we're seeing in the stock market right now. Again, you can argue that it is probably a bear market rally, but what is going to be the reaction function if we do retest those lows, which seems quite possible if you do get that second wave? That what does the Fed, or what does the central bank do next? Do they begin directly buying equities? And this is something that I talked to Jared Dillian about. It's like, well, again, everyone's going to argue and complain that that's immoral and wrong, but what are they going to do? You have to, as an investor, I think you just have to look at it and say, well, what are they likely to do? Whether I agree with this policy decision or not, what are they likely to do? And so that's personally my view, is that at some point, again, like, it's the same thing. You can come back to Canadian housing. Like, okay, if this thing gets out of control, where prices decline a lot, or more than policymakers like, who's to say that they cannot bring in a 40-year amortization or ease credit restrictions, just work with the banks? Again, you can argue that's the right thing, or won't happen, will happen. Is what do policymakers typically do? You've built a economy, you've built a financial system on the back of rising asset prices, trying to generate consumer spending, which is over 65% of your economy. So that's just the way that the system is built. So unless you plan to get a full reset, I don't see how policymakers are going to take any other reaction function. So that's my view of it. We can actually see right now is my initial hope to some extent was that they wouldn't bring in negative interest rates. I think that it's been proven not to work, but policymakers have proven time and again to go back to the same well. In fact, it seems like the bond market is actually pushing them towards that direction, where we actually saw Fed futures, so i.e. the direction that bond traders are betting on where the U.S. Federal Reserve interest rates will be at the end of the year. They were actually pricing in negative interest rates, and so a lot of the times you'll see that the Fed, the central bank, will see that the market is pricing that in. They don't want to necessarily upset or tip over the apple cart and disrupt the market. So they typically say, well, let's not upset the market. If the market is pricing that in, let's roll with it. Now, again, maybe they'll go in a different direction, but it's starting to seem that negative interest rates could be a realistic tool that these guys go for. And again, I don't like them. I disagree with them. I think that morally it's wrong. But now we have to think about an investment framework that is going to potentially work in that negative interest rate environment. Again, I'm not going to get into the semantics of where you should be in negative interest rates, but I think that becomes more of a real asset class. Obviously, gold, Bitcoin. Paul Tudor Jones came out recently, gave it the rubber stamp of approval. And I think in the long run, once you get through that deflation, I think real estate is a real asset. That's my personal view of it, and that's all I got this week. So if you got any sort of value entertainment out of that video, thumbs up, subscribe. Again, I'm gonna have Steve Keen on here next week. We'll probably discuss a lot on credit, housing. Those are two topics that he's extremely knowledgeable and extremely passionate about. And I think he's going to provide a lot of value, and he's going to talk a lot about policy making, what central banks can or should be doing. So I think that's going to be a lot of value, and looking forward to that. So see you next week.